Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week is news you can use, and on today's show, our annuity update for December 2013. And with me today, nationally recognized annuity expert Mike McLaughlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Mike.
It's great to be here.
Well, I've been looking at bankrate.com as I do every month to see what the 5, 7-year, 10-year rate, but let's just talk about the 5-year rate. I mean, when you look at the 5-year bankrate.com and compare it to fixed interest rate annuities, I mean, that spread is something to talk about.
And again, just like we talked last month, the 10-year Treasury continues to hover around the 2.7% mark. It's a great opportunity for any advisors to take a look at that spread. Our 5-year best-in-class rates are somewhere typically around 2.5 right now, depending upon the carrier and the week with the fluctuations in the 10-year Treasury. But that is still a significant premium to the client when they're looking at interest rates. It's as wide as it's ever been, and now is as good a time as any to purchase a fixed annuity.
Well, Mike, for our producers who deal with consumers that are very much into certificates of deposit, this is a story because I still find after 30 years in this business that most of our consumers who are CD purchasers do not know the power of tax deferral, because that's the second issue. It's not just the interest rate spread. It's the power of tax deferral. Talk a little bit about that, even though you and I know this is a common area, but for consumers, it's just not.
You know, accumulation is really something that the industry has lost sight of. We've been so focused on income planning that the pure fact of, like you said, simple tax-deferred accumulation makes a significant difference over a 5 to 10-year period. Not only do you have the rate spread, but you also have the tax deferral spread and an explosion of value and a clear differentiation between any type of annuity versus a taxable CD type of investment. And then when you compound that with the opportunity to be linked with an equity index in a tax-deferred environment for an opportunity to outpace fixed annuities and CDs, then that gives the client a great opportunity to grow on a tax-deferred basis and accumulate money for retirement way above what current CDs are earning.
And remember, everyone watching us, I have a piece on this from Backroom Technician on the power of tax deferral. If you want it, we'll send it right to you. When I'm thinking about, you mentioned indexing, let's segue right into the fixed indexed annuity Barclays. This Barclay product, I mean, Mike, you're really high on it. Let's talk about it.
Yeah, this is a new index that was introduced by Allianz about 3 months ago, and in its introductory launch, it has sold $1.5 billion of premium going into the Barclays index. It is a game changer for many of the fixed indexed annuity carriers. This index works exactly like an asset allocation mutual fund. It is managed on a daily basis. The allocation changes daily between the S&P 500 and the Lehman Brothers bond index. So it is there to reduce volatility in the overall gain. But what's nice is that Allianz has been able to provide this to the clients with an uncapped strategy. The pricing, instead of a cap, is a spread, which right now is 1.7%. So if that index goes to 11%, minus the 1.7% spread, that index historically has outpaced any annual point-to-point cap method in the industry right now. A lot of people are talking about that. When you look at so many of the variable annuities changing and forcing their clients to go to asset allocation models, nothing more aggressive than a moderate conservative asset allocation, this gives a perfect opportunity for clients to use an index strategy that is going to be very similar to an equity bond allocation that you would find in a moderate asset allocation classification. And at the same time, you have a lower cost income rider and also an income rider that will increase the check to the client every time that the Barclays is a positive movement in that index. So it is a triple win for the client. Guaranteed types of return from a baseline of a fixed indexed annuity, an uncapped S&P blend with the Lehman Brothers, and at the same time, a good quality income rider that is guaranteed to keep up with inflation as the bond index and S&P increase as well.
Now, Mike, this surprises me because generally everybody's using caps and not spreads. So is this the lead spread even from a historical standpoint and what's offered on our spreadsheets?
Yeah, this is, again, it's catching the eyes of everybody. It's probably our best priced and historically test out best for a client in terms of overall rates of return. The uncapped nature is very attractive for clients that maybe have been burned in the market, and gives you an opportunity to catch up some of those lost gains that they've had on sitting on the sidelines.
Mike, touch a little bit about this ING lifetime income annuity. I mean, that's kind of hot right now.
Yeah, we've really are high on that. It's a great opportunity for an income play. If you put in $100,000 over 10 years, that's guaranteed to grow to 225% of your initial deposit, and you can take income out of it. What's hot about it are two factors. One is that it's an annuity that is actually dispersed on a last in, first out basis. So if you're using $100,000 of non-qualified money, the client receives their initial deposit first. So if you're working with someone near retirement and could put $100,000 in and they start taking income at age 70, they get their first $100,000 back completely tax-free as their cost basis, which is really unique in the insurance industry. That allows an advisor to mix and match maybe some RMDs from a taxable account and offset some non-taxable income through the ING lifetime income annuity. So it gives a lot of flexibility in the planning arena.
When we come back from the break, we're going to continue our annuity update for December 2013. And don't forget, you can request our best-in-class annuity spreadsheets on our website at downtobusiness.ashbrokerage.com. And remember to sign up for your own 30-day free trial offer from Backroom Technician at brtnow.com/trialsignup.aspx. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back. I'm Steve Savant with Mike McLaughlin. And remember, you can watch all the episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right out at ashbrokerage.com. Just click on the show logo right on the homepage. And just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're continuing our annuity update for December 2013 and addressing some index annuities and featuring a unique annuity product. Well, Mike, I want to talk a little bit about it in our second segment. I want to open up with this allocation strategies using single premium immediate annuities and fixed index annuities, because everybody always complains, Steve, why are you doing combination when the interest rates are so low on SPIAs? Tell them why the math works and it's a superior combination strategy.
Well, I think that there's so much pressure right now when you're reading up newspaper articles about a 4% distribution strategy. Historically, that was a very safe withdrawal percentage for clients that could get them all the way to their life expectancy. The reality is now, with the correction from 2008, that 4% really can't be depended on in order to get the client all the way to their life expectancy. So a lot of times what we will take a look at is splitting up the income distribution, and we can dramatically reduce the pressure of the amount of money that's on assets allocation that has to be withdrawn. We can reduce that pressure by as much as 20%, and that gets the client to have their income last for the rest of their life. So irrespective of where interest rates are right now, the fact is that when you're using the SPIA as well as some other withdrawal techniques through guaranteed living benefit riders, whether it's VA or fixed index, it's a great opportunity to take pressure off of the assets under management.
I noticed you have a hot marketing sales idea called FIA Sales Concept. Let's transition into that because this is a really great strategy.
Yeah, we think that the fixed index annuity is really an opportunity to outpace fixed annuities and widen that spread that we talked about on the CDs. If you take a look at historical averages of the S&P 500, it has been above the current cap rates of 5.5%, nearly 60% of the time. So if you were to hit the cap rate in 4 out of the 7 years, I believe that you would walk away with somewhere in the neighborhood of about $124,000 to $130,000, depending upon whether it hits 4 or 5 out of the years. That is somewhere in the neighborhood of $7,000 to $8,000 more dollars in the client's pocket versus a fixed annuity, and several $1,000s more versus a taxable instrument like a CD that we talked about in the first segment. So the propensity for the index to perform on a more normal basis going forward gives the client an opportunity to really outpace any type of other conservative investments.
Mike, I saw that you have a case study that kind of dips your toe into this on product allocation. Talk a little bit about this. We'll put it up on the screen. Tell me why you chose this as a great case study.
Well, again, this talks about the value of indexed annuities as well as SPIAs and doing a combination. We're looking at a lot of typical Americans that need about $50,000 of income at retirement, and their average account balances are somewhere in the neighborhood of $750,000. And it goes back to that 4% distribution rule. If this couple is going to take $20,000 from Social Security, they need about 4% off of that remaining $750,000 in order to survive and have some type of lifestyle. What we do is we work with clients and advisors to reposition those assets. In that study of Genworth that was just recently released, 85% of Americans believe that they need to have a baseline of income coming in to have a comfortable retirement. So we will reposition approximately $150,000 into a SPIA, and that will provide us with approximately $9,000 of income for the rest of their life guaranteed. We then put $100,000 into a guaranteed living benefit rider, whether that's a variable annuity or a fixed indexed annuity. That's going to generate another $5,000. So that when we have to withdraw $16,000 off of the other $500,000, that reduces the pressure on that assets under management account from 4% distribution down to 3.2, which makes it very much more tolerable and more likely for that $500,000 to last until the client's life expectancy. So we think that that baseline guaranteed income is a huge cornerstone to any type of income planning opportunity going forward.
Mike, I noticed that you mentioned the Future of Retirement Income Study by Genworth, and we're giving that away to anybody that calls into the annuity department and talks to the team. It's 1-800-589-3000, extension 1202, and we'll send you that and another doc by Genworth, which is really cool, and I think you'll appreciate it. And Mike, we can send them the case study as well. Is that so?
Absolutely. Just call our sales desk, and we'll be more than happy to walk everybody through the case study.
Well, Mike, I think you're talking about that Allianz product is probably your lead on your best in class right now for index. Is that correct?
Absolutely. It is garnering a lot of good looks, and it is performing well on illustrations, doing back testing. I encourage everyone to take a look at that, as that is, we're hearing a lot of other carriers take a look at allocation type of indices. So that is really kind of the lead dog right now.
Who's our fixed interest rate for people who are certificate of deposit type of consumers? Who's the play 5-year, let's say?
We still sell a lot of Reliance Standard and American Equity. Both are right around the 2.25 to 2.5 range. But again, relative to the other conservative investments, it is blowing away any type of CD rates by close to 175 to 200 basis points.
And lastly, any SPIA that you look at, sometimes people say the interest rates are low, but a lot of people have differing mortality crediting methods. So do you have one that you like for people that are 60 and above that was really our play for lifetime income they can't outlive?
Well, I'm really partial to Western and Southern, as well as to Genworth. Both offer a lot of different commutation options. And again, it's an opportunity where you used to think of SPIAs as give the insurance carrier your money and it's gone. You'll never see it again except for that monthly check. And if something happens to you prematurely, then you've made a bad investment decision. With commutation, it allows you to take money out as much as 90% of the period certain and you can take cash out, reinvest it if interest rates choose, or if you have that emergency and need cash, then you can have access to it as well. Those are the features that I think advisors need to be talking about with their clients going forward.
Well, that's our show for today. Remember, you can read all my online insurance news commentary, advisor blogs, and articles on Producers Web, as well as my answers to consumer questions on the Insurance Library. And you can view any of our past episodes on our on-demand section located at downtobusiness.ashbrokerage.com. So follow me on Twitter, Facebook, and LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor.